Markets could crash if this line is crossed. Hi, everyone, and welcome to another episode of Insights brought to you by Ainslie Bullion and the Gold and Silver Standard. Today, we welcome back Sam, who's been looking at some levels in the US markets, specifically the S&P 500 index, that if they break could be a massive sell signal for investors. It's certainly looking a bit precarious. So how are you going today, Sam?
Very well, thanks, Chris. How are you?
Yeah, I'm good. It's been really a bit of a roller coaster ride over the last couple of days in the US markets. We've had the stock market in America really being surprisingly resilient in recent months, despite the higher rates. But all of a sudden, we're seeing these falls. So, how would you attribute that? What's going on there?
Well, since October 2022, the S&P's been making a really strong recovery. And one of the narratives that helped support it was that the Fed was supposed to, they were bluffing. As soon as the market's going to fall, they're going to turn around and, start stimulating the market and let it recover. And I don't know why that is, because they haven't done that in the past. They've been perfectly happy, for example, in the 80s to let the market crash in order to fight inflation. So why it's different now might just be hopium or wishful thinking, but that fantasy people had that they're going to just prop the markets up in any sign of a turnaround, that didn't happen. And when Jerome Powell came out and spoke, he made that very clear, and his tone was very negative. And in fact, this good news is bad news thing, well, he talked about the bad news in a way like it was inevitable. He was essentially talking about a market crash that's coming, which really gave people the feeling, either he knows something that we don't know, or he's going to make this happen. He's serious. He's been saying he's going to do what he's been saying, which is hold rates higher for longer and not just turn around and pivot and make easy money again.
I suppose it's such an interesting thing to look at, because when you think about, he has been absolutely consistent, exactly as you've said. But I suppose when we went through that COVID period and the stimulus was just so large, I wonder if we have a bit of a recency bias there, where we go, well, even before that, when we had the GFC, we're just used to something starts going wrong and they pull out the bazookas, like they certainly did during COVID. We've never seen anything like it with the amount of stimulus that was provided. So, maybe we all just become a little bit complacent, or, have learned to not really believe that these words can mean that they can mean what they say, because it's been so long since we've been in a, in quotes, normal environment. Maybe there's something to that. But
yeah, and people forget as well that there was the COVID crash. There was a sharper sell-off than the Great Depression, but the recovery was so quick, people just forgot about it. So
that's true.
That was a bit of a reset in itself.
It's that our minds tend to paper over the negative because we only remember the positive of that, and we forget. Yeah, that's a very valid point. It was end of the world sort of stuff we were looking at that point, where it just was crashing. I know the stops came in. You'd be watching on, late at night for us, but you'd be watching on the financial news networks in the US, and the market would open and be shut 5 minutes later because it had limit down, just crazy periods. But yeah, you're right. We forget all about that. So I know you're looking specifically at levels, and there's an excellent chart you've sort of put in with a very clear level on. What is that what you're looking at to judge whether it will keep falling, or whether we shouldn't believe what they're saying? How are you looking specifically at the chart?
Yeah, so if you look at the chart, you can see I haven't laid out a horizontal line. So this isn't an exact level. It depends on when it reaches the line, and it did test just this morning. But what I'm looking at is a trend line, because there's been a rising trend line for almost exactly 1 year, and the market's been bouncing up off of this trend line. And more recently, it's even gotten more aggressive because, things usually move in waves. Typically, you'll have 3 waves up, and then you'll have a correction downward. Well, we've had a couple waves up and then a really aggressive third wave up, and it's just coming down now to test this trend line. So typically the third time test can be a make or break, and that's what's happening right now. And I think that if it breaks this line, the stock market could be in huge trouble, because you can listen to speeches, you can listen to analysts say what they think is going to happen, but if you see on a chart a rising trend line that's been for the past year break, that's a really clear sign that something's wrong.
Yeah, and it is crystal clear on that chart you provide, because you really are drawing a line in the sand, and I like that. And I think people watching will like that as well. That you're making a definitive statement on where that line is, because I think that matters, right?
Yeah, and technical analysis. I mean, people say technical analysis and fundamental analysis, they're very different things, but essentially they're the same.
Yep.
For example, if you have, say you have a rocket, so you light the rocket and it shoots up into the sky. And it say that you light off a few rockets and they each go up 1,000 meters and then they fall down. Now, the fundamental analyst would say that it's because they only have 1 liter of fuel each, and that's how high they can go, and that's why they turn around. The technical analyst would say it's because there's a resistance line at the 1,000-meter level, so they go up and they hit the resistance and they bounce back down, and that's the resistance line for this level rocket. Now, they're both just different ways of looking at the same thing, but the thing is, with a chart, it can be indicative of the real fundamental situation that they don't want to tell you. And what is happening, whether anyone likes it or not, is the US stock market, or the S&P 500, which is what we look to see how things are going, whether that's logical or not. It is going down and it is retesting that trend line. And it has had 3 waves upward, and it is looking very, very bad.
And I really like that analogy. And often when we talk about technical analysis, we have to remember that the chart is telling us the reality one way, like that is what the price is. So it's not making it up, where we can have lots and lots of narratives around why that's happening. It's fact at the end of the day that the price is what it is, and that it has been where it has been. So that's very useful. I noticed that the tone in finance, like sort of in the mainstream financial media at least, has been a bit more to the negative side around this, as you would expect, because you start to see a bit of selling off, and very quickly it turns to gloom and doom, because I suppose that sells subscriptions to watching their analysis as well. But do you think they're running out of reasons to say everything will be okay? Because up until now, it's been really quite positive, and they really have been running the positive angle on this.
Yeah, well, they have to face the music. They have to face what the Fed's been saying, and they have to face what's been happening on the charts as well. And if you look at, some speakers, they're not even just really giving into the reality. Some are beating the drum. Like if you look at Jamie Dimon of JP Morgan, he's very famous for his fiery rhetoric. He called certain other investments frauds and things like that, and then now suddenly he's interested in them. So you have to keep an eye out for people who are trying to smash things so they can just get a better entry point themselves later. And he's been talking to the Times of India recently, and the way he was talking about interest rates was he was saying questions as kind of like statements. Like he was saying things like, I'm not sure if the world is prepared for 7% interest rates.
That's a pretty provocative,
which is why,
quote unquote, question, isn't it?
Yes. And he's talking about stagflation plus 7% interest rates plus all these things. Why are you talking about all these Armageddon situations in the news like they're definitely going to happen? Well, it might be because the market looks quite toppy, and it might be time to take advantage and push the market down. Are they selling off now? Are they looking for a better entry point? We talked the other week, we can see the central banks were selling off. So why wouldn't they? They're second in line, I guess you could say. So yeah, the bad news is starting to come, and it looks like some of these talking heads are getting pretty excited about it.
And it's interesting too, because when you mention central banks, like they probably are constrained to some level of what they can actually do. But when you're talking about Jamie Dimons of the world, they're not as constrained. They can play these games to a higher level. Even though I know there was a lot of outrage from a discussion we were having recently about what the Fed was actually doing, and you had governors from the Fed who were effectively profiting from what was happening during that rate cutting cycle and rate rising cycle that came after it. So, there's a lot of concern and corruption, or not necessarily full on corruption, but certainly questionable ethics going on in a lot of these players.
Buying the bottom and then lowering rates and then selling the top before you hike. It doesn't get much better than that, does it?
No, that's right. And really, of all the people that shouldn't be able to do that. But anyway, we digress. So this brings us to probably a conclusion that you can make about where you see or what predictions you can make based on this recent data. What are you thinking? Where do we end up from here?
Well, there was just the credit conditions index. It was released from the American Bankers Association, and they have they have a lot of economists from banks speaking, and they had a few predictions and they had a few expectations as well. So one of them is that they expect conditions in the credit market to get worse across the next 2 quarters. And what they saw was a fall in the consumer credit index. They saw the headline credit index fall. And the only thing they saw increase by a very, very small margin was the business credit index. But then it was almost unanimous. They see that it's going to get worse. So that was their prediction. And it's not too much of a surprise that they would see this. It marries up with the charts quite well when you're looking at the stock market and you're looking at their predictions for the credit crunch to get worse in America. And what that means is, people running out of savings and pulling investments and not spending. And I don't know if you talk to people around the city who are involved in, deliveries, wholesaling, all these sorts of things, they're all talking about slowdowns, which is anecdotal, but I mean, you can see it happening everywhere. People are just spending less money because they're running out.
Yep. And that's certainly something we've been discussing, noticing from our on the ground anecdotal evidence in the Ainslie offices, where you've had really the absolute prime time for people to be coming in and buying gold and silver. And it's not that they don't want to. A lot of people are just tapped out at this point, aren't they?
Yeah, there's not enough money going around to, get in investments when they're dipping. And look, we'll see when this trend line is retested on the S&P. If that cracks and falls, you could see big discounts on a lot of things. It could even temporarily knock down the gold price a little bit more and give, like it has been currently, a really good entry point, which, like you said, is difficult for people to get into at the moment.
But those who can, that's the harsh nature of this market, isn't it? Those who can get in at these opportunities are the ones that really benefit from the next cycle, because they get those fire sale prices.
Yeah, absolutely.
Yep. Well, Sam, thank you for that. As always, a great sort of depth of analysis and insight into what's going on in the market. And we'll certainly be watching closer to see what's happening in those US markets, the S&P in particular, because it's not looking pretty at the moment. And you've got a clear line there that we need to be paying attention to. So we'll come back next week and assess how that's going.
All right. Sounds good.
Thanks everyone for watching. Remember, reach out with any questions or comments on the social platforms. That's us for this week. We'll be back on Tuesday with Alex to discuss all things markets and metals. Until then, have a great rest of the weekend, everyone.